David R. Guttery is the president of Keystone Financial Group in Trussville, Alabama. David Guttery and Brandon Guttery are financial advisors and represent Emeritus Investment Company, LLC. Please stay tuned through the end of the video for additional important disclosure information.
Hello everyone, I'm joined by David Guttery today, president of Keystone Financial Group here in Trussville, for a discussion about current market volatility and a high-level glance at the November elections. Hey David, welcome and thanks for being with us today. Let's start with your thoughts about volatility that we've seen in the markets in September. Is this just normal market movement or the beginning of something negative?
This is one of the most often asked questions that I've received this month. Clearly, the volatility that we have experienced throughout the year has taken a toll on the average investor's nerves. And psychologically, each period of weakness can carry increasingly greater weight. Having said that, when a market experiences a period of consolidation, it doesn't mean that it's the beginning of a new extended period of sell-off. In fact, markets that are in the recovery phase following an acute shock rarely move forward in a straight line. There are always periods of time where short-lived retracements allow for investors who may have missed the previous upswing to enter the market with idle cash. In that light, periods of consolidation and retracement within an otherwise extended recovery pattern are healthy. As we normally do within these videos, let's take a quick look at the market as represented by the S&P 500 index. As of the close on the 25th of September, the S&P 500 index had returned to positive territory for the year and was up by 1.22%. Since the intraday low established on the 23rd of March, the index is higher by 50.52%. We have come a very long way in a relatively short period of time. It is not uncommon for individual and institutional investors to harvest gain along the way, and for sector rotation to take place, and for algorithms to play a role in exacerbating volatility. In the long run, this is healthy. Ideally, we would like to see a broadly based market rally rather than one specifically led by narrowly focused sectors. As we have noted on many occasions, high-level advice is worth noting, but at the end of the day, every individual should be guided by their own objective, tolerance for risk, and everyone should remain mindful of the time remaining between now and the fruition of those objectives. If you are relatively close to your objective, then it could be that having significant market exposure risk is not the most ideal situation for you. Conversely, if you have many years between now and your objectives, periods of volatility like this can offer many opportunities to establish positions in the market that could potentially serve you well over the long term.
Well, that makes a lot of sense. David, last month you described the strength of the economic recovery following the COVID-19 shutdown. Could recent market volatility be related to a potential slowing of those economic metrics?
Within last month's video, we looked at a basket of economic metrics. When you connected the dots of the results that we have observed since February, a very discernible letter V was evident. For those who may have missed last month's video, please go back and review it. The trends that we observed 30 days ago remain intact today, and indeed, many of those trends continue to gather momentum. There is no question in my mind at the present time that our economy continues to strengthen by the day. I would like to observe the fact that 6 months ago, virtually no one in the national mass media suggested that we would experience a V-shaped recovery. We've heard about the letters L, W, and even the letter K, but hardly anyone suggested that we would observe a V-shaped recovery. Clearly, as of last Friday anyway, this is precisely the pattern that we see developing across a myriad of economic metrics. Remember that sometimes the letter V is inverted. Here we see the TED spread, and we've talked about the importance of this indicator within many of our previous videos and podcasts. Clearly we can discern the inverted letter V. As of last Friday, the TED spread stood at 14 basis points, and that is about as tight as I have ever seen this metric. At a high level, this suggests, to me anyway, that the bond market perceives that current economic conditions are strong, and they are likely to remain strong over the coming months.
Well, that's a great observation. Thank you for that. But now I have to ask you to look into your crystal ball because, as you know, we have an election coming up in a little over a month. Do you see the result of the election having an economic impact or an impact on market valuations?
With regard to the political landscape, there seems to be two schools of pervasive thought. For years, we have heard that the markets don't care who occupies the White House. To a large degree, I agree with this school of thought. The markets are neither Republican nor Democrat. Markets simply want to know what the rules are as they pertain to trade, tax, healthcare, immigration, and many other areas that directly and indirectly impact the market and thus the economy. This year, however, I do believe that market direction as a function of economic strength or weakness will be directly impacted by the results of the election. On that note, in mid-October, we will produce a detailed podcast specifically devoted to this topic. Please follow us on social media and our website so that you may receive the podcast when it is published. At a very high level, the differences between the candidates as they pertain to trade, tax, and other factors that will impact employment and consumer sentiment could not be more diametrically opposite. Because of this, it does stand to reason that the market will respond as economic assumptions are priced into current valuations as a function of who may find themselves in office in November. Right now, as of Monday the 28th of September, I don't believe that I see any of the metrics that we follow pricing an election result into themselves. Now that is likely to change over the coming 30 days, however, and it is something that we will follow closely. Our general advice to clients at the present time is to remain true to the investment strategy that you have adopted for the attainment of quantifiable goals. Tactical changes may be needed to that strategy over the coming months, but for right now, I would suggest that people be observant, avoid the sensationalism of the mass national media, and stay the course.
Well, David, thank you so much as always for this great information, especially at such an important time. For additional information, David may be reached through the means listed upon the following screen. For the Trustful Tribune, I'm Brannon Dawkins.
David Guttery and Brandon Guttery independently offer securities and investment advisory services through Ameritas Investment Company, LLC, member FINRA, SIPC, and Ameritas Advisory Services. Information provided in today's segment is gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed and should not be interpreted as tax or legal advice. Any performance stated is past performance and is not indicative of future results.